Hi everybody, Stephen here again. What a week we've had. We go from finding out that the average age of a first-time home buyer is 40 years old now, to finding out that one of the ideas being floated to save us from this peril is a 50-year mortgage. Guys, come on. I want to talk about both of these things a little bit for a few minutes here. I hope you'll listen in because I think it's really important to know. First of all, you don't have to wait until you're 40 to buy your first home. There are ways, there are different things available. There are down payment assistance programs. There are buy down programs to get that interest rate better. You may not be able to make your first home your dream home, but you can have your first home, start building some wealth, start getting prepared to step up to what is at or near your dream home in a matter of just a few short years from buying that first home that may not be a dream home, but it's really a nice place to start. I'm old and I'm going to show my years a little bit, but we always called them starter homes back in the day because we knew it wasn't where we were staying. We knew it was a stepping stone. It was ours, and it was the beginning of building our own personal wealth. So, maybe we just need to shift our thinking a little bit, but beyond that, let's move ahead to. I'm sorry, it's like to this 50-year mortgage idea. I'm going to start out by saying, guys, it's garbage. I said it. It is what it is. I'm not making any political statements here. I'm going on pure economics. A 50-year mortgage is absolute garbage. Here's why. Let's compare two loans, a 30-year loan and a 50-year loan. Folks, borrowing money costs money. There's no way around it. You are going to pay dearly every time you borrow money for anything you borrow money for in life. That's the trade-off. Now, the 30-year mortgage, where do I begin? I ran these numbers on a $400,000 loan, not a $400,000 purchase, but an actual loan amount of $400,000 at 6.25% interest. I ran the interest the same on both the 30 and the 50, even though in reality a 50-year mortgage is going to cost you a higher interest rate. So, based on the generosity of 6.25, 30-year, 50-year, here's what we're looking at. First of all, the payment on a 30-year mortgage is $2,462. That's principal and interest. The payment on a 50-year mortgage is $2,179, principal and interest. The difference of $283. $283 savings a month, but you've added 20 years onto the amount of time it's going to take you to pay back that loan. I hear you. I'm listening. I heard you. You said you're only going to stay in this home for a very short period of time. This is your stepping stone. This is how you're going to get to the next one. This is how you're going to start building your personal wealth. I love this. I absolutely love this. This is the way it was meant to be. But let's talk about what that really looks like from a 30 to a 50-year loan. Let's say 5 years in, that's fair, right? 5 years is what you think you'll probably pay on that loan before you sell that house and step up to the next one. 5 years in on the 30-year loan, you have gone from $400,000 down to $373,348. You have trimmed $26,651 off your loan. Congratulations, not bad. If you're on the 50-year loan, you have trimmed your balance from $400,000 down to $393,219. You have trimmed $6,780 in 5 years. Let's put this a little bit clear. The bank owns $393,000 worth of your house. You own $6,700 worth of your house. On the 30-year loan, the bank owns $373,000 and you owe $26,600. Better. Still tough numbers, but at least with the 30-year, you could feasibly sell the house, make enough money because obviously the value has gone up in 5 years. So the equity that you realize from the appreciation in price, plus the $26,000 you've paid into it, you should be able to take that, roll that into a new home, and start building something better. Good. The 50-year loan, fear you may not even break even. Just being honest, I don't think you're going to be able to roll that into something new and something better. So you say maybe, oh, Stephen, I'm going to stay for 10 years. Okay, let's do that, because that's obviously better. More time, you're going to have more money to spend. It's going to be great. So let's run those numbers real quick. So on the 30-year loan, you've stayed in for 10 years. This is great, folks. If you stay 10 years, this is going to work out really well for you. You've gone from a $400,000 loan balance down to a $336,950 loan balance. You've given yourself $63,000 in paid equity, plus whatever the value of the house has gone up over time, which it will have gone up. That's really not bad. That's something you can really work with, you can really be proud of, and you can really take it a pretty decent step up. Yeah, you got the 50-year loan, you stayed 10 years, you got the cheaper payment, the $283 a month cheaper payment. But this is all wonderful. You have paid that loan down in 10 years from $400,000 to $383,959. I'll do the math for you. It's $16,040 is what you've paid off of your loan. You own $16,000 worth of your house after 10 years. The bank still owns $383,959. Please say those numbers resonate with you. 50 years for a mortgage is garbage. You're never going to get ahead. The banks are going to make a lot of money. You are going to die renting the house that you thought your children were going to inherit. Do you hear me? You're going to die renting the house that you thought your children were going to inherit. 30 years is the most you should consider for a loan. Look at other ways to get in that house. People, down payment assistance programs, rate buy-down programs. Have a really good real estate professional on your side when you're at the negotiating table. You need somebody who can step into the arena without emotion and fight like hell to get you the best price on the house you're trying to buy.